USHY crushed SCHI with 30% returns and recovered twice as fast, just 450 days versus 1,000. USHY bounced back in 450 days. SCHI took 1,006, that's 556 extra days, stuck underwater waiting to break even. USHY's outperforming with 30% returns versus SCHI's 24%. That's a meaningful 6-point advantage over 3 years. Over 5 years, USHY crushed SCHI, delivering 25% returns while SCHI managed just 9%. USHY's been crushing it like a race car with a turbo engine, nearly triple the speed over 5 years on the same track. USHY's Sharpe ratio of 1.0 crushes SCHI's 0.6, much better returns for every unit of risk taken. USHY's higher Sortino ratio means it's delivering better returns while protecting you from the downside that really hurts. USHY's getting an A for risk management while SCHI barely scrapes by with a B-. Same market conditions, wildly different report cards. USHY held up better when markets crashed, losing just 16% compared to SCHI's 21% drop. SCHI took nearly 3 years to recover. That's 1,000 days of watching and waiting just to break even. USHY bounced back to break even in just 15 months, half the time most funds need after major losses. Think of it like marathon runners recovering from injury. USHY was back sprinting in 1 year, while SCHI hobbled along for 3. USHY's 7% yield beats SCHI's 5%. That's 40% more income flowing into your pocket annually. USHY pays you $7 per 100 yearly, while SCHI gives 5. One's actual spending money, the other's just pocket lint collecting dust. SCHI's 0.3 correlation means it won't crash when stocks do. USHY's 0.7 correlation offers much less protection. SCHI's 0.1 beta means it barely flinches when stocks crash. USHY's 0.3 beta shows 3 times more sensitivity. Think of correlation and beta like dance partners. SCHI barely follows stocks' moves, while USHY dances closer to equities. Lower numbers mean better protection. USHY dominates across every metric. Better returns, stronger risk-adjusted performance, higher yield, and recovers from losses more than twice as fast as SCHI. SCHI's razor-thin 0.03% fee costs less than half what you'll pay for USHY at 0.08% annually. USHY's 6% outperformance absolutely dwarfs that tiny 0.05% fee difference. It's not even close here. Expense ratios are like couch change. SCHI saves you nickels, USHY earns you hundreds. Both matter, but returns trump tiny fee differences every time. Both these funds deliver identical 7% volatility, same price swings, but very different return profiles underneath. USHY delivered 25% returns versus SCHI's 9%. Same volatility, but way more reward per unit of risk. Same volatility, but USHY delivers 3 times the gains. It's like choosing between a bunny hill and a real roller coaster to the top. USHY's $27 billion in assets dwarfs SCHI's $10 billion. Clearly, more investors trust USHY with their money here. 2 funds, 2 personalities. USHY offers higher yields for moderate risk takers. SCHI prioritizes stability for conservative investors. USHY races down the highway chasing bigger returns, while SCHI takes the scenic back roads where it's safer. Different routes, different risks. Choose your road trip wisely. Standard legal disclaimer. Do your own research and consult professionals before investing. Want more breakdowns like this? Hit subscribe for weekly ETF comparisons, risk analysis, and income strategies tailored for you.